Hello everyone, this is Kaeppel of Sentimentrader.com. I'm flying solo on the recording this week, doing it myself due to a little snafu with timing from Negocius TV in Spain. So the first chart today is actually courtesy of Dean Christians here at Sentimentrader.com. If you recall back at the start of the year, the narrative was that we were headed for recession, therefore the stock market is pretty much doomed to decline. Of course, what a lot of people forgot is that the stock market is a leading indicator of the economy and not the other way around. So at the top of this screen, you see our macro index model, which ranges essentially from 0 to 100. Higher readings portend good things for the economy and vice versa. And what Dean tested was when this index drops below 30% and then reverses back above 60%. In the middle chart, you see the red dots on the S&P 500 index. Those are the previous occurrences, and the most recent was 1st of July this year. And what Dean found, if we look at the very bottom, is that the stock market, the S&P 500, was higher 86% of the time 2 to 6 months later. So basically what this suggests is that the bull market is intact and that we should continue to give the bullish case the benefit of the doubt. On to the second chart. I showed this one a couple of weeks ago. The lines were red at the time. This is the technology sector, ticker XLK, and the industrial sector, ticker XLI. And what we see at the far right is that these sectors have broken out to the upside. And when the leaders continue to lead, that's a good thing for the stock market. So basically what happens now is what was once resistance is now support. So I really encourage traders to keep a close eye on these two, because as long as they remain above recent resistance, which is now support, it's very bullish for the market. On the other hand, if they break down, particularly, for instance, if technology were to break back below that level around 177, that would suggest that maybe things are changing in the market and that we could look for a broader pullback. But for now, so far, so good. But it's something to keep an eye on. Chart number 3 is, here we go. Ticker IBB is an ETF that tracks an index of biotechnology stocks. And in the middle, the green line is the 50-day moving average of our optics sentiment reading for this particular ETF. And what we see, all the red dots there, is when sentiment goes below 45 and then moves back above that level, tends to be favorable for the technology sector. The black line at the top is actually ticker XLK, again the technology sector. And the key thing to note at the bottom is following these red dots in the past, 2 months later, the technology sector has been higher 85% of the time. It's a very favorable win rate. The one thing to keep in mind is the ones that did not work out tend to be double-digit losses. So there's an issue of money management involved. One simple thing would be to combine this with the previous chart and say that we'll continue to hold XLK as long as it stays above support, and maybe we'll think about cutting a loss or reducing a position if it breaks below it. So far, everything looks pretty bullish. But one thing I always caution people, especially when we're talking about sentiment, is what always happens, human nature, it never changes. As the market moves higher, investors become more bullish, and as it goes lower, they become more bearish. So when we reach a point where we've been recently where it's almost easy to make money, people get a little giddy. And so my caution is always be looking for things that question whatever your outlook is on the market. So most of the things that I follow are bullish. However, something that still continues to bother me is shown on this chart. These are not price charts. These are charts of the yield or interest rates on Treasury securities. And the yield curve, if we look at the upper left, the 30-year Treasury bond, which should be paying the highest rate of interest, because when you buy a 30-year bond, you're essentially locking in a rate for 30 years. It's paying 3.9%. If we look at the lower right-hand corner, a 3-month T-bill is actually offering a return of annualized 5.25%. This is not normal. This is an example of an inverted yield curve. Now, technically, the yield curve has been inverted for almost a year. And so at some point, people start to ignore it and say, well, maybe it doesn't mean anything. And maybe it doesn't this time around. But to me, this is still a warning sign that reminds me that there's something amiss in the financial markets, and we need to remain vigilant and not get too carried away with whatever bullishness we may be feeling as the market moves higher. So those are my charts of interest for this week. Thank you very much for stopping by.